This is the Chris Berry Show. Expert information on elder law, retirement, and estate planning. Information that you can understand. Here's your host, Chris Berry.
Welcome to the Chris Berry Show, where we talk wealth, estate, and tax planning for a safe and secure retirement. This is your host, Chris Berry, and I'm very excited this week. We're going to have a special expert, a CPA colleague of mine, Matt Sova. He's going to talk about some of the tax changes that we're experiencing, some things to do at the end of the year with your own tax planning. And I like to start each week of the Chris Berry Show off with a positive focus. And my positive focus this week is I'm recently back from San Diego, where I had a wonderful class, a workshop with IRA guru Ed Slott. And I'm one of Ed Slott's Master IRA advisors. And I think I'm part of maybe 1% of attorneys and advisors in the nation who are Ed Slott Master Advisors. And you might have heard of Ed Slott. The Wall Street Journal has called him America's expert on IRA planning. He has shows on NPR, public television, and he's really an expert when it comes to retirement planning, retirement account distributions. When we're talking about IRAs, Roth IRAs, Ed Slott's name is at the top of the list. And so every quarter I spend time, take a couple days out of the office to work directly with Ed and the other master elite IRA advisors. And so I thought I would share some of the things that we talked about on this segment of the Chris Berry Show. And it's really going to be a tax-heavy show today. So bear with me. I know taxes aren't the most exciting things in the world, and I kind of joke around that we deal with death, taxes, and incapacity. That's my profession. Those are the things that I worry about for my clients, making sure that they have a safe, secure retirement, protecting them from things like long-term care costs, unnecessary taxes, probate, etc. So it's not the most fun, exciting thing in the world, but it's important to understand because I really think tax planning is something that not enough individuals, not enough retirees and soon-to-be retirees think about when it comes to putting together their holistic financial and legal plan. Too often, tax planning it's not thought of at all. It's all about tax preparation. So looking at what you did last year and then paying tax. But not enough people are really focusing on what you can do in the future. Because really, this is one of the few areas that you can take control of your planning. You can take control of your future. Now, you can't control what tax rates are, or the marginal tax rate. You certainly can't control what the market's going to do. You can't control laws. Sure, you can vote and that type of thing, but Congress is going to do what Congress will do. The market's going to do what the market's going to do. So anyone who tells you that they can control the market or time the market, I think they're full of it. But what you can control is tax planning. So you can control when and how you pay tax. And so that's one of the things that we focused on at the Ed Slott workshop. And that's one of the things that we're going to focus on today on the Chris Berry Show. And stick with us in our second and third segments. So no questions and answers this week. I apologize. So if you did shoot a question to us, we're not going to be able to get to it this week. We'll try to get to it next week. But our second and third segments today, we're going to have deep conversations with Matt Sova, an expert CPA who's been doing this for quite a while. He's seen a lot of different things. And speaking of upcoming episodes, our next episode is going to be, or our next show is going to be November 11th, Sunday, and that's actually Veterans Day. So we're going to have a show dedicated to the veterans benefit. We're going to talk about the different benefits that are available. We're going to talk about service versus non-service connected pension and compensation. We're going to talk about the recent changes in the VA rules. And then also one of the things that our firm is doing in honor of our veterans and surviving spouses of veterans is that if you give us a call or email us on either Veterans Day, which is November 11th, or the next day, Monday, November 12th, which is Veterans Day observed, if you give us a call or email us on those specific days, what we'll do is we'll set up a time for you to get a free financial and medical power of attorney. Now, this is only available to veterans or surviving spouses of a veteran. And you must call us on either Veterans Day, which is Sunday, November 11th, or Monday, Veterans Day observed, November 12th. So give us a call at 810-355-2584 or email us anytime at askchris@thechrisberryshow.com. And again, that's available to veterans and surviving spouses of veterans. In honor of Veterans Day and your service and your sacrifice, our firm will do a free financial and medical power of attorney if you're a veteran or surviving spouse. And it's just our way that we give back any way that we can to help those veterans and surviving spouses out there. So that's going to be on the next show next week. We're going to be on Veterans Day talking about veterans benefits, and we're going to be offering free financial and medical powers of attorney to veterans and surviving spouses of veterans. If you reach out to us on that Sunday, which is Veterans Day, or Monday, November 12th, which is Veterans Day observed. And so getting back to this week's show, we're going to kind of do a deep dive into tax planning. I'm going to talk about some of the tax traps that we see, some of the hidden tax traps that we see. That's going to be on our first segment, and then our second and third segment will be with a local CPA, Matt Sova, who's going to give us some things to think about as the year is wrapping up from a tax planning perspective. What can we do at the end of the year? And then also just talk about some of the changes of this new tax plan that is going into effect for 2018 to 2025, some things to think about. So we're going heavy on the taxes. Bear with me this week. So now let's talk about some of those hidden tax traps. And these are what I call the retirement tax traps. And the first one is just specifically the tax trap of retirement. And this is something Ed Slott has spoken on. This is something that we've touched upon on the Chris Berry Show, is this, we call it the ticking time bomb in retirement, the ticking tax time bomb. And so what we're talking about specifically is what happens when you turn 70 and a half. Well, what happens at 70 and a half, if you're not aware, is that you have to start taking out required minimum distributions. So once you turn 70 and a half, all of this pre-tax money that you've done a great job of building up and accumulating during your lifetime, so all of that 401k money, all of that pre-tax IRA money, all of that money, well, now at 70 and a half, you have to start paying income tax on it. And you have to start taking out what's called required minimum distributions. And those required minimum distributions start off at, I want to say, 3.65% the first year, and they go up each year thereafter. And basically, they're on a table with the idea that by age 115, you've paid all the income tax. So why we call this a hidden tax trap is a lot of times people don't realize that they're going to have to pay income tax on certain income streams in retirement. They assume that, well, I'm done working. All of a sudden my income's going to drop down. My wages are gone. I don't really have to worry about income tax anymore. I'm going to be at such a lower tax bracket, it's not even going to matter. Well, that's one of those hidden traps in retirement. And we call that the tax trap. So because what happens is a lot of times people have more income than they realize when they reach 70 and a half. Because first of all, you have to take out those required minimum distributions if you haven't done effective tax efficient planning ahead of time. Because now you're 70 and a half and you have to take out those RMDs. And guess what? That counts for income tax. Then on top of that, if you have a pension, well, guess what? Your pension is going to get taxed as well. So now you have your RMDs coming out, you have this pension coming out. And then on top of that, if you have RMDs and they're high, and you also have a pension, then what else might be taxed? Well, your Social Security might also be taxed. So you add up all this income and you might be paying more tax than you thought in retirement. And then on top of that, depending on the tax scheme we have at the time of retirement, you might lose a lot of those deductions. And Matt is going to talk about how some of these deductions have went away, but there's 4 common deductions that people typically have in retirement that lower the amount of income tax they have to pay. And those are mortgages, which again, Matt's going to talk about how that's went away in our current tax scheme, dependents, and contributions to 401ks or IRAs, and then charity. So a lot of times in retirement, we've lost a lot of those on the back end. So not only do we have more income up front, but we have less deductions on the back end. So we find that we're paying maybe the same, if not more, tax in retirement. And so one of the ways that we can avoid this is coming up with a tax plan ahead of time prior to 70 and a half, looking at paying the income tax sooner rather than later. In our next segment, Matt's going to talk about how we can look at charitable contributions as a way to minimize some of that. So stay tuned in our next segment with Matt. Then the second retirement tax trap is the excess trap. So you might not be aware, but with your qualified accounts, your 401ks and your IRAs, there's only a certain period of time when you can access those accounts without penalty. And so prior to 59 and a half, if you're to take out that money early, you're going to pay a penalty unless you have certain exceptions. And it might be a 10% penalty that you have to pay on your money. And then what happens if you wait till after 70 and a half? If you don't take out your required minimum distributions, well, guess what? The government's going to hit you with a 50% penalty. So the government doesn't mess around. So those qualified accounts, they're putting some limitations on when you can and cannot access those funds without any type of penalty. And if you misuse or miss time when you're taking money out of those qualified accounts, or you don't have a valid exception, you could face a penalty of anywhere from 10 to 50%. And then the third retirement tax trap is the distribution trap. And it's not managing your distributions in retirement. So like I said, when you turn 70 and a half, what happens is you have to start taking out your required minimum distributions. And so we need to make sure that we take those distributions out in an intelligent manner. So this involves, first of all, making sure that we take out enough so that we're not penalized. But then also, maybe it makes sense to take out more than just whatever that required minimum distribution is. Maybe we should look at taking out more than that 3.65% if we're at 70 and a half. Because if I were to ask you a question, do you think taxes are going to go up or down in the future? Most people raise their hand and say they think taxes will go up in the future. Now, if you're driving, please don't play that game. Keep both of your hands on the steering wheel. But a lot of people think taxes are going to go up in the future. So it might make sense, if that's the case, to look at taking out more than just your required minimum distribution. Maybe we look at moving that money into a Roth account. Maybe we look at investing that money in another form of tax-free retirement income like permanent life insurance. Maybe we look at moving that money into a castle trust so it's protected from the devastating cost of long-term care. Maybe we look at, as Matt talks about, looking at charitable contributions as a way to minimize the taxes and move money out of those tax-deferred accounts to diffuse that ticking tax time bomb in retirement. So the third trap is that distribution trap. Now, the fourth retirement tax trap is the death trap. So, and Matt's going to talk about this a little bit in our third segment, specifically as it relates to leaving money to minor children in the kiddie tax. But understand that if you do have these large pre-tax qualified accounts, so qualified accounts, things like IRAs and 401ks, those would be pre-tax qualified accounts. Post-tax qualified accounts would be things like a Roth IRA or Roth 401k. So what I'm talking about here is I'm talking about the pre-tax qualified accounts. Things like IRAs, 403bs, 401ks, 457s, SEPs, those types of things. Those are pre-tax, meaning you haven't paid income tax on them yet, but when you take the money out, you have to pay the income tax. So when we're talking about this fourth trap, the death trap, what we're talking about is, well, guess what? When you pass away, it's not like the taxes all of a sudden disappear. Uncle Sam, they want their money. The Internal Revenue Service, you have to get out of that partnership with the Internal Revenue Service. So if you haven't paid the income tax while you're alive, understand you're leaving that tax to be paid by your kids or your beneficiaries. And this could be a problem, especially if the children are in a higher tax bracket than you are, because guess what? When they take the money out, they're going to have to pay income tax on it. So I was sitting with a family, and they're basically kind of running their family like a family office, where it was just only child, and mom was still around, but dad had passed away. And basically everything was kind of put together. They're running it all together. And so we were looking at a plan where we would have mom pay the tax sooner rather than later for a couple reasons. One, because the child was in a much higher tax bracket than mom, so it made more sense to pay the tax now. And then also, mom wasn't planning on passing away anytime, but she had a a number of years ahead of her, she hoped, and so she thought the taxes were going to go up in the future as well. So all things being even, she decided to pay the income tax sooner rather than later, because if the government does raise taxes, and a lot of people think it will, because we're $21 trillion in debt these days, she decided to pay the income tax sooner rather than later and do some Roth conversions. Now, it's not Roth contributions. She was doing Roth conversions. And so that's something to think about as you talk about leaving money to the next generation. Does it make more sense to leave Roth money that you've already paid income tax on it, or does it make more sense to leave pre-tax dollars, so your traditional IRAs or 401ks? Well, if you think taxes are going to go up in the future, and especially if you have children who are maybe professionals in a higher tax bracket than you are, if you look at minimizing the amount of tax paid to the government and maximizing the amount of money that's available to your family, maybe it makes sense to pay the tax now versus leaving this pre-tax money to the next generation, where during their high income years is when they have to pay the income tax. Even if they stretch out those qualified accounts, doing stretch IRAs, where they have to pay the required minimum distributions, it would still be at a higher tax rate because they might be in a higher marginal tax bracket. Or let's say you're leaving it to grandchildren, then as Matt's going to cover in one of our upcoming segments, we have to worry about the kiddie tax as well. So again, if you have a choice as a beneficiary, what's better to receive, qualified pre-tax money or Roth money? From a beneficiary standpoint, it's always better to receive that money that's already been taxed, that Roth money. So that's a quick snippet into some of the things we talked about at that Ed Slot workshop. Join us in our next segment as we bring on our CPA Matt Sova. Join us after the break.
The cost of care for an elderly loved one or a loved one with a chronic illness is shockingly expensive. If you are dealing with the unbelievable cost of care, make sure you get all the benefits you're entitled to. Here's certified elder law attorney Chris Berry from the Elder Care Firm in Brighton.
Most of my clients are really concerned about long-term care costs. They don't know where to turn, and what we can do is put together legal strategies to protect your resources and also bring in additional resources to help pay that cost of care. One of the things that they often say is that I wish I knew about this years prior. And unfortunately, the information's out there, but there's just so few certified elder law attorneys. As the only certified elder law attorney in Livingston County, it's my job to make sure that our seniors, our loved ones, our veterans have the best quality of care possible and the best quality of life possible.
Protect your hard-earned assets from probate, long-term care costs, and the IRS. The Elder Care Firm will get you the governmental benefits you deserve, including veterans benefits and Medicaid. Visit theeldercarefirm.com and schedule a free 15-minute phone consultation. That's theeldercarefirm.com.
And welcome back to the Chris Berry Show, where we talk wealth, estate, and tax planning for the second half of life. And I'm very excited to have a guest expert on, Matt Sova, who's a CPA in the area. Matt, how you doing this morning?
Not too bad, Chris. How about you?
I'm doing fantastical. So, Matt, I wanted to have you on because we're getting near the end of the year, and I figured there's some things that our listeners could do in terms of managing taxes and moves we can make at the end of the year. But before we get into some of that, Matt, why don't you tell me how you got into the world of tax, which up there with death and incapacity doesn't seem like the most exciting things in the world.
Well, when I was in high school, my senior year, I was trying to figure out where I was going to go with my life, and I took an accounting class. It came very easy to me. I knew it was a profession that there was always going to be a need for, so I pursued that in college, and 4 years of college and passing the CPA exam, and away we go. Nice.
Yeah. My undergrad was in finance. I took one accounting class, and I decided that I did not want to do accounting. I got into accounting light finance. That was enough for me.
Yeah.
So how long have you been practicing as a CPA then?
30 years.
30 years.
30. Is that right? Yeah, 30 years.
So you started when you were 5, right?
Yeah, right.
So I'm sure you've seen some things change over those 30 years. What have you seen change over the last 30 years of practice?
Well, there's been a lot of different changes through the years in business as well as personal tax. Obviously, the the largest change I've seen is the most recent tax law changes that are coming up for starting this year in 2018. It wasn't a complete rewrite of the code, but there was substantial changes across the board. And so there's a lot of information out there, and there's a lot of stuff that, we've got to learn. We have to have education every year, number of hours of education every year. We've got a 2-day tax seminar coming up at the end of November that me and my staff are going to bone up on all the new tax laws and make sure we're fresh for tax season.
Oh, where's that at?
It's going to be in East Lansing.
Oh, okay. All right. I'm actually, I just got back from San Diego for a workshop, so a little bit warmer.
Yeah.
Yeah. So I think that's one of the constants is, especially on the law side as well as the tax side, is that the rules are always changing. And I think you hit the nail on the head. You have to stay up on these types of things. And we know that with this Trump tax plan, a lot of things have changed. So with this new tax law that's starting this year, maybe what are some of the big highlights of things that have changed? Maybe just big picture.
From the personal end, you're going to see a lot fewer people itemizing deductions.
Sure.
They basically doubled the standard deduction. And you either take your itemized deductions, your mortgage interest, your property taxes, your state taxes, contributions, etc., or you take the standard deduction, whichever is greater.
Yeah.
So for married filing joint, the standard deduction went from $12,600 to $24,000. So that's a big nut to get over with itemized deductions, unless you are a very charitable person and give quite a bit, or you've got a lot of mortgage interest. Because there's a couple other things that they've done that will change the itemized deductions.
Sure.
All the taxes that you pay, property taxes, state taxes, and license plates, stuff like that, you're capped at $10,000. So if somebody had $17,000 of taxes, a higher income person, they're going to be capped at $10,000 on that. And another thing they did is they got rid of all the miscellaneous itemized deductions. So tax prep fees, investment advice.
Sure.
Somebody that drives their own car for a living and they're not reimbursed mileage, they can no longer take that mileage. So there's some big cuts on the itemized deduction end as well. So you're going to see a lot of people moving away from Schedule A and not itemizing deductions anymore.
Okay. All right. So just so I understand, to clarify, now things like tax preparation, investment advice, are you still able to take deductions, but it's just that you're not going to utilize that because you're going to rely on the standard deduction, or did they get rid of those deductions entirely?
The stuff I was talking about, like the tax advice and such, those were what were called miscellaneous itemized deductions that were subject to 2% of the adjusted gross income.
Okay.
That section is gone.
Completely gone.
Completely gone.
So that wouldn't even add it to...
That's correct.
Okay.
Yeah. So you still get your charitable contributions, you still have your mortgage interest, and you still have your taxes that you can deduct to a point. And the medical deduction is still in place, albeit the floor is now 10% of adjusted gross income. So
okay. All right. So I guess with that, if we have this higher standard deduction, would a possible strategy be to look to try to bunch all those deductions in 1 year if you're going to be doing charitable donations and that type of thing?
Yes, exactly. So if somebody is a fairly charitable person and they, let's say they give thousands of dollars to their church every year, maybe 1 year they don't give anything, and then the next year they give right at the beginning of the year and right at the end of the year that large amount, so they can itemize deductions every other year and take advantage of their mortgage interest and their property taxes and such.
Sure. That reminds me, I'm going to have a conversation with my church with my donations so they stay off me for a year or two as I bunch these all together.
Right.
But I think that's an important point to understand, is that there's some planning opportunities around this fact that we do have standard deductions. Now, what about things like contributions to, say, 529 plans? Are those still deductible, like if I contributed to a Michigan State 529?
Yeah, the contribution to the 529 plan it's not deductible at the federal level, but if you make the contribution to a Michigan 529 plan, you can take the deduction on the state of Michigan return. So it will reduce your state income taxes.
Okay. All right. And so not obviously because I'm asking the question. So the change at the federal level hasn't really affected how we fill out taxes at the state level, correct?
Correct.
Okay. All right. So what about someone who has taken or has to take money from their retirement accounts? Is there a way that they can reduce their tax bill given this higher standard deduction?
Yes, there is. If let's say they won't be able to itemize now because they're not going to have over $24,000 of itemized deductions, and they're over 70 and a half, so they're subject to the required minimum distributions from their IRAs or 401ks.
Yep.
What they can do is do a qualified charitable donation, and what they do is they contact their wherever their IRA is, Fidelity, say, or Schwab, what have you, and they direct them to take a portion of or all of their required minimum distribution and send it directly to a charity. So they still make the charitable contribution. So let's say the required minimum distribution is $20,000, and they normally give $8,000 to their church through the year. They contact the
Plan administrator?
Yeah, thank you.
Sure.
And ask them to make $8,000 contribution over to the church.
Okay.
They send the $8,000 to the church. They pull out $12,000 for themselves.
Sure.
So they've satisfied their $20,000 distribution. Okay, but on their tax return, on page 1 of their tax return, the only thing that's taxable is the $12,000. So $20,000 doesn't show up on page 1, and then $8,000 is lost in the wind because you can't take.
Right.
You're not going to be over the standard deduction.
Sure.
You're only going to be taxed on $12,000.
Okay.
And it's not just at the federal level because the state starts with adjusted gross income.
Sure.
It's going to reduce your state taxes as well. So it's a great planning opportunity for people that like to donate and they're charitable.
Okay. So how does that, help me out here, how does that work with that higher standard deduction? Would we want to make sure that we're taking out enough to get above that standard deduction or?
No.
Okay.
No. Like I said, if, imagine it's, they're over 70 and a half, their house is paid off, so they don't have mortgage interest.
Right. Yeah.
So maybe they haven't, even when it was lower, they didn't have enough, or they were barely over that $12,000 limit, even with giving $8,000 to their church.
Okay.
Now, they're not going to be able to qualify for standard deduction. Okay.
Sure.
So it's going to reduce adjusted gross income is what we call in my profession above the line or below the line.
I've heard that. Yeah.
Itemized deductions are below the line.
Okay.
They're after itemized deductions. The
Sure.
qualified charitable donation is above the line.
Okay.
So it's before adjusted gross income.
Okay.
So itemized deductions doesn't matter. You still get the full standard deduction, and you've reduced the amount of taxable income because you've reduced your adjusted gross income.
Okay. All right. So if I can kind of restate that. So this strategy would be for those who are over 70 and a half who have to take out required minimum distributions but are looking to try to minimize their taxes and they have a charitable interest?
That's correct.
Is that right?
Yep.
Okay. All right. And so what they would do is they would then take a portion out of their qualified accounts, the 401ks, the IRAs, and then a portion of that would then go to the charities of their choice, right?
Right.
Yeah.
They would have to contact the plan administrator and have them send the money. They can't take the money and then go and give it to the church.
Okay.
That ruins the qualified part of it. So, yeah, contact the plan administrator, have them send the money directly.
Okay. And in working with financial institutions myself as well as with our clients, do you see the financial institutions handling this properly, or is it something?
Yeah, this is actually
a CPA you'd get involved with?
Yeah, this is something that's been around for a few years.
Okay,
but it hasn't been widely used.
Sure.
And sometimes in talking with people, I don't want to do that. I like to put my envelope in the basket every week at church, and it's like, well, the church would understand,
Right.
But
Yeah.
with maybe before they were still able to itemize deductions,
Sure.
and now they're not going to be able to.
Right.
So this is a good opportunity for them to still be able to make their charitable contributions. Maybe it's not the church. Maybe they have special charities that they donate to every year. They'll still be able to do that and reduce their taxable income because the itemized deductions don't come into play in this situation.
Okay. So would this be for people only over the age of 75, or would it be people looking to get money out of those tax-deferred accounts, maybe even before 70 or 70 and a half, not 75?
Yes. Yeah, I mean, you normally are looking at people over 70 and a half because they have to take the required minimum distributions, but some people that are under 70 and a half, they don't need to take the distributions. They usually are generous and charitable,
right?
And they're looking at their retirement account, going, "Man, I'm going to start getting killed in a few years on taxes. What can I do?" Well, you can start doing that now. If you've got charities you want to give to, you can do qualified donations.
Awesome, yeah. And so, Matt, I think, and this is one of the reasons I wanted to bring you on the show, that I find a lot of tax preparers are just looking at what happened in the past, and I love how this is a strategy that's actual tax planning, like looking forward, looking at how to minimize taxes this year as well as in the future. And if people want to get a hold of you or they have questions on this strategy, what's the best way to reach you?
They can call my office at 810-220-5710, or they can send me an email it's matt@sovacpa.com.
Wonderful. And if you go to thechrisberryshow.com, we'll make sure to have Matt's information in the show notes. So he just went over a great strategy in this new tax regime for those over 70 and a half to minimize taxes, specifically on those required minimum distributions. Or if you're under 70 and a half and you're in between that magic window of 59 and a half and 70 and a half, where you can access your qualified accounts without any type of penalty, to move money from those tax-deferred accounts and also donate to charity while minimizing any income tax needs. And we're going to continue with Matt in our next segment. But Matt, I want to ask you one more question, and maybe we'll continue this in the next segment. So I understand that the exemption for a taxpayer spouse and children is now gone, and it sounds like this could be detrimental to families. Have they done anything to make up for this lost deduction? And maybe just before we hit the break, you could talk about this exemption that's gone away, and then we can talk about what we can do.
Yeah, they did get rid of the personal exemptions, and so if you have a family of four, they were receiving a $16,200 deduction with their exemptions, and if both the children were under age 17, they also got a $1,000 per child tax credit, which reduces the tax itself. Mm-hmm. Under the old law, the issue was that child tax credit started phasing out at $75,000 of adjusted gross income for head of household, mm-hmm. and $110,000 for married filing joint. The exemptions would also phase out, but at a much higher level of income.
Yeah.
So what they've done is...
Well, actually, let me interrupt you. So before we'll get into what they've done, let's take a short break and join us as we continue this great discussion with Matt Sova, a CPA. And if you want to get a hold of Matt, his information will be in the show notes. But we're going to continue in the next segment talking about some tax planning strategies in this new tax environment with our expert today, Matt Sova. And if you do have any questions, you can always email us questions at askchris@thechrisberryshow.com. Again, askchris@thechrisberryshow.com. Join us after the break.
If you or a loved one is facing long-term care costs, make sure you talk with certified elder law attorney Chris Berry from the Elder Care Firm, like Sherry Skelton and her family did from Fenton.
It's really scary when you know that your parent deserves a certain quality of life and you're not able to afford it unless you get these benefits. And that was the place where we were at. We were like, we couldn't take care of her. We all had families of our own. We all worked. And of course, we wanted her in the best possible place that we could afford. And none of that would have been, we never would have been able to do that if it wasn't for them. I always recommend Chris. And I always tell people when they have any questions, I just say, you know what, you need to contact this guy because I can't even begin to tell you what he did for my family.
Hello, I'm attorney Chris Berry. The Elder Care Firm is here to help you and your family find solutions.
Call us today.
Protect your assets from probate, long-term care costs, the IRS, and get the governmental benefits you deserve. Visit theeldercarefirm.com today or call 810-214-3800.
And welcome back to the Chris Berry Show. And we still have our special CPA expert guest, Matt Sova. And Matt, we were just talking about the exemptions. And like I said, I understand the exemption for a taxpayer spouse and child is gone. And it sounds like this could be detrimental to a lot of families. So my question is, do they do anything to make up for that lost deduction?
Yes, they did. So as I was explaining, the previous exemption was $4,050 per person. So a family of four would have $16,200 reduction in their income. And then there was the child tax credit for children under age 17 that was $1,000, and it phased out at a fairly moderate income level. Mm-hmm. So the exemption, if you had somebody in the 25% tax bracket under the old law, each exemption was worth about $1,000 in tax. Mm-hmm. And
so that would be extra $1,000 in my pocket?
Correct.
Okay.
So with that gone, what they did was they increased the child tax credit for children under age 17 to $2,000.
Now, is there a limit on the number of children?
No.
So I can just keep having children and keep collecting $1,000 checks?
$2,000.
$2,000.
Yes.
Okay, all right.
But you still have to, kids cost more than $2,000 a year, Chris.
That is
part
true.
Of the problem.
My 8 and 5-year-old, that is true. I see that.
So what happens is the phase out range under the new law has also increased for head of household. It's gone from $75,000 adjusted gross income to $200,000 adjusted gross income. Married filing joint goes from $110,000 to $400,000. So
if you make up to $400,000, you can still keep the credit.
The full credit.
Okay.
Correct. And then it starts phasing out depending on how many children you have, how big that credit bucket is that you have, and how long it's going to take to phase out. And also for children over 17 or any dependent you have that's over 17, there's a $500 tax credit. So if somebody is taking care of their elderly parents and claiming them as a dependent, they don't get a dependency exemption anymore, but there's a $500 tax credit to help things out. So that's what they've done to change that around.
Sure. All right. Then I've also heard something about this marriage penalty. What is that, and what are they doing about that?
Well, the marriage penalty has been around for a long time, as long as I can remember. And so basically, if you had two individuals making about the same amount of money, and they got married, they might find themselves paying taxes in a larger bracket than they ever had before. So under the old law, if you looked at the two lowest brackets, 10 and 15%, the married filing joint was exactly double the single. So they both, so if you had two people, they were both in the 10 or 15% bracket. When they got married, they'd still be in that same bracket.
Oh, okay.
Because their income wasn't high enough.
Sure.
But if you look at the 25% bracket for single people, last year that ended at $91,900, and then you get into the 28% bracket. Married filing joint wasn't $183,200. That ended at $153,100.
Oh, wow. Okay.
So that's where it started. And then as you got into higher income people, it got a lot worse. The 33% bracket, for instance, ended at $416,700 for both married filing joint and single.
Right.
So if you had a couple single people both making about $400,000, don't get married. That was the tax advice.
Yeah. That's kind of interesting. So it's almost like this old kind of the husband works, the woman stays at home.
Exactly.
Yeah.
Exactly. And so what they did is they've changed the brackets. All the brackets are changed, and the new brackets being 10, 22, 20, 10, 12, 22, 24, 32, 35, and 37. All the married filing joint brackets, except for the 35 and 37% bracket, are double the single bracket.
Okay.
So it's really alleviated a lot of that marriage penalty. So if you have a two-income household, you're not getting kicked into a higher bracket because you both are fairly successful.
Right. So. Oh, okay. All right. That makes a lot of sense. And then speaking of those brackets, they've expanded those brackets, right? Where
Yes.
now,
Yeah.
if you're making X amount of dollars last year, if you make that same amount this year, you might be in a lower bracket, right?
Correct.
Yeah.
Correct.
Okay. And now with these these new tax brackets we're working under, how long do we have these? Is this going to be forever, or?
Well, that technically it's through, I believe it's 2025, and then like anytime they've had any sort of tax things that had a phase out or a sunset date,
Sure.
Congress would get together and they'd put in an extension and they'd extend it for a year.
Right.
And sometimes they would do this in January of the year that just ended, retro to the January of the year before. So then we sit around waiting for the IRS to get everything ready so we can start filing taxes.
Right.
And it really puts stress on on our profession and people as well that, wait a minute, I want to get my tax return done. I can't get them done because IRS is still trying to rework their computers for the Congress put in this extension.
Right.
So hopefully Congress in the future will be a little more proactive and put in extensions in a timely fashion.
Yeah. In one area where we both saw this was with estate taxes. So for our listeners, if you don't remember, prior to I think it was 2001, correct me if I'm wrong, I think Bush put into effect these estate tax exemptions that had a sunsetting provision that started at about $600,000 and then every year would go up to $1 million, $1.5 million, $2 million, $2.5 million, $3.5 million.
Correct.
And then what would happen is 2010, the estate tax exemption was scheduled to go away. So it had this like sunsetting provision. Well, okay, guys, figure it out before 2010 happens.
Right,
and
exactly.
Then if our listeners remember, 2010, we actually had zero estate tax, but I know we had some capital gains and other kind of issues. And if I remember correctly, I think there was 4 billionaires that passed away in 2010, including George Steinbrenner, with no estate tax. And then
good planning on their part.
Exactly, yeah. It's, put the pillow on at the right time.
Exactly.
Yeah. And then it was scheduled to come back to $1 million and continue on. And that's where we then, they finally got around to making a change and they bumped it up to $5 million. So now estate taxes, where are we at right now?
The exemption is like $11 million. And so if you have a couple that's married and their estate's over that, they should make sure they plan properly to utilize both $11 million exemptions and get the full $22 million. Yeah.
So for our listeners, if you have $22 million and you're married, you might have an estate tax issue. And if so, if you're looking to adopt either me or Matt, we will rent ourselves out as children if you need to alleviate some of that estate tax woe, looking to pass that on to beneficiaries. Now, what about giving income-producing assets to children as a gift as part of an inheritance? Are there any tax issues involved with this new tax regime that we're dealing with?
Yeah, the common name for it is the kiddie tax.
Sure.
And what happened was this came about in actually the '86 Tax Reform Act because wealthy individuals would give income-producing assets to their children, basically just title it in the children's name and then take it back when they turned 18. But and then that way it would always be taxed at the lower children's rate and not at the higher parent rate. So the original kiddie tax, it was up until the kid was 14, and then it changed a number of years ago to anybody under the age of 19 or under the age of 24 and still a full-time student, so college kids.
Sure.
And the kiddie tax was it's a complex area that always required additional forms and complicated computations to figure out how much is being taxed at the parent's rate and how much is at the kid's rate. And they did away with that portion of it, and they said, okay, what's going to happen is the kiddie tax will be the unearned income, capital gains, interest, dividends, Social Security, will be taxed at trust rates rather than at individual rates.
And let's take a second to talk about what that means, because for a lot of people, they might not understand how trusts get taxed. And just one thing, when we're typically setting up trusts, we almost never have the trust tax. And maybe you can talk about why that's important to understand.
Yeah, because the trusts reach the top bracket very quickly.
Right.
And they also only have 4 tax brackets in the trust bracket. So they have a 10% bracket, a 24% bracket, a 35%, and then the 37% bracket, which is reached at $12,500 of income.
Right, which that's crazy if
Yes.
you compare that to like the married filing jointly or single.
Right,
so
exactly.
You never want your trust to be taxed at that compressed trust tax rate.
Exactly.
Yeah.
So what they did is, okay, if you have a child that has under $1,050 of unearned income, dividends, interest, capital gains, Social Security, IRA withdrawals is another one.
Yeah.
Then there's no tax because it's under what would be their standard deduction for that. The next $1,050 would be taxed at 10% because that's where the trust 10% bracket ends. And then it goes into the 24% bracket, would be taxed on the next $6,600 of that type of income. And then the following $3,350 would be taxed at 35%.
Sure.
And then anything over $12,500 is taxed at 37%. So a lot of people think of it, the kiddie tax, just affecting dividends, interest, and capital gains.
Right.
But if somebody passes away and they leave an IRA to a child, a traditional IRA, that's going to be taxable income, and the child has to follow required minimum distribution rules for pulling that money out.
Okay.
And if it's a large amount that's coming out, they're going to have a big tax bill.
Oh, wow.
So one of the things you might want to, if somebody's got a traditional IRA money and they have Roth IRA money,
right,
and they want to leave something to the children, leave the Roth IRA.
Yeah.
Because the Roth IRA is all tax-free money.
Sure.
As long as it's been around for at least 5 years.
Okay.
So
this is a really interesting point. So let's kind of dive a little deeper into it and help me understand and our listeners. So one of the things that we hear a lot of times is that you want to leave the IRAs, that traditional money, to the youngest individuals possible, because the way that the required minimum distributions work for an inherited IRA, if you set things up correctly, the amount or percentage that they have to take out is based on their life expectancy. And so if you're leaving it to someone very young, then that RMD coming out would be maybe even less than what the amount of interest is earning in that IRA. So that's that stretch IRA concept. But what you're saying is that you have to factor in the kiddie tax?
yeah, that's going to be the issue now is you have to look at, what's going to be the required minimum distribution for this child?
Right.
Okay, and then apply the kiddie tax to
Right.
it. Now, if the IRA isn't so great that the amount is going to be nominal,
Right.
It's going to be under a couple grand, so they're going to only have a little bit of tax, that's fine.
Right.
And then the thing that you have to look out for, though, is, little Johnny's going to use this to pay for his college.
Right.
Well, now, if he's going to take out a big chunk to pay for college, he's going to get hit with a big tax.
Oh, wow. Okay.
So the best thing to do there is go and get even though I don't like student loans,
Sure.
go and get student loans.
Yeah.
And then when the child graduates from college and is no longer a student, then pull it out, and it'll be taxed at their normal rate at that time.
Okay.
And you
So
avoid the kiddie tax.
So just so I can understand, if I can restate that. So it would make sense to maybe look at the child still taking out those student loans. Don't use the money from the qualified accounts because that would trigger the kiddie tax. Take out the student loans, and then once you're free from the kiddie tax, and what's the age where the kiddie tax isn't an issue anymore?
Well, once they graduate from college,
Okay.
the year after that, they won't be subject to the kiddie taxes. They'll no longer be a dependent of their parent.
Okay.
So
Okay.
if somebody graduates from college at 22 years old, then the next year, pull the money out of the IRA and pay off all the student loans.
Sure.
And and go on with life.
Okay. Well, great. Yeah. So that's it's an interesting kind of diving deep into that issue of leaving qualified money to the next generation or the generation after that. We have to take into account that kiddie tax. And Matt, I just want to thank you for sharing all this information. If our listeners want to get a hold of you or have some questions, what's the best way to get a hold of you?
They can reach me at my office at 810-220-5710, or they can email me at matt@sovacpa.com.
All right. And Matt, maybe one last thing. What's something that someone should be thinking about, just something simple that they should be thinking about as they're, the end of the year is coming, and maybe a last-minute tax planning tip? Anything real quick that you might have for our listeners, whether it's looking at Roth conversions or something like that, something very easy for them to do? If they're looking at converting money to a Roth IRA, check out the new brackets, where you think you're going to be, and try and keep yourself in as low of a bracket as possible. Another thing is to look at what you normally have in itemized deductions, and would this be a good year to bunch your charitable contributions to get you over the $24,000? Or is that something that should wait? So. Yeah. Matt, thank you so much. I appreciate that advice. And for our listeners, it's important that you work with a professional. There's a lot of pitfalls and potholes in this type of planning, where if you do something for one thing, it might have effects in other places. So make sure to work with a professional. And I want to thank Matt. Thank you for spending time with us.
Thank you, Chris.
And join us on the next week of The Chris Berry Show. Thanks for listening, everybody. Make it a great week.
Learn more about Chris Berry and the Elder Care Firm by visiting online at michiganestateplanning.com. That's michiganestateplanning.com. You can also call Chris Berry at 888-390-4360. 888-390-4360. This program content reflects the opinions of Chris Berry and his guests, not the Elder Care Firm, Prosperity Capital Advisors, or the C.J. Berry Group, and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment or legal advice or a recommendation regarding the purchase or sale of any security or to follow any legal or tax strategy. There's no guarantee that the strategist's statements, opinions, or forecast provided herein will prove to be correct. Past performance is not a guarantee of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses, which would reduce returns. All investing involves risk, including the potential for loss of principal. There's no guarantee that any investment plan or strategy will be successful. We recommend that you consult with a professional dedicated to your needs. This program is furnished by the Elder Care Firm.
The cost of long-term care can be overwhelming. If you're dealing with long-term care costs, make plans to attend the next free informative workshop from the Elder Care Firm in Brighton. They'll show you how to protect your hard-earned assets and obtain the governmental benefits you deserve, including veterans benefits and Medicaid.
Hello, I'm attorney Chris Berry. As the only certified elder law attorney in Livingston County, I have the knowledge and estate planning strategies to help you. When you call, reserve your seat at our next workshop or schedule a free 15-minute phone consultation. The Elder Care Firm is here to help you and your family find solutions. Call us today.
Spots are filling up for the next free Elder Care Firm workshop. Reserve your seat today by calling 810-214-3800 or visit theeldercarefirm.com. The Elder Care Firm also invites you to join them at this year's Walk to End Alzheimer's. The walk is on Saturday, October 1st in downtown Brighton. Call 810-214-3800 today.